Hello, everyone, and welcome to this week's Money and Markets Squawk Call, where we go around the horn with our editors to get their insights into the markets. Today is June 8th. My name is Mark Najarian, and with us today we have Mike Larson, Mandeep Rai, David Dukevich, and Kathy Lean. While the S&P index is trading at a 7-month high, despite the fact that we just received a disappointing jobs report last Friday that saw the U.S. economy add only 38,000 jobs. And that's a sharp drop from the average hiring pace of about 200,000 a month since the recovery began. As a result, the odds of a Fed rate hike in June or July plunged. Chances of a July rate move were better than 50-50 before the report, and now they're around 20%. And of course, we have the uncertainty of a presidential election hanging over the markets. That's all affecting stocks, bonds, currencies, and commodities. Let's start with Mike Larson. Mike, you've written a lot this week about the bond markets and what they're telling us about economic prospects. What are you seeing now in the markets?
Yeah, thanks, Mark, and welcome, everybody. To me, this move is all about what's going on in currencies and bonds. The stock market's almost a sideshow. If you look at the bond market, I mean, everybody on CNBC talks about how great stocks are. But have you noticed that the TLT, the long bond ETF, is up about 11.5% on the year right now, whereas the S&P is up about 4%? So basically, you've gotten 2.5 times the return of stocks from just buying the long bond. If you bought gold, you're up something like 17% as of yesterday in an unleveraged position in the GLD, which is almost 4 times the increase, or roughly 4 times the increase of the S&P. So stocks aren't where the action is. It's really what's going on in bonds. This relentless QE bid, because of the ongoing passing of the baton from madness to madness by central banks. The Fed has been sort of on the sidelines for a while, but the Bank of Japan has picked up where the Fed left off. The European central bank's going even more crazy with their QE over there. So you're seeing a relentless rise in bond prices, decline in bond yields. That really is pushing German bond yields to an all-time low. There's an average yield measure that's published by the Bundesbank over there in Germany, and it just dropped below the zero threshold. The 10-year German Bund is about to do the same thing, the current on-the-run 10-year German Bund. Switzerland just issued a 13-year note as a zero-coupon bond, basically no yield at all. Yields on existing Swiss debt are negative out to 20-year maturity. It's sort of this relentless process where you're just chasing price performance with bond prices up and yields down. I will 100% guarantee that this will end in disaster, just like the last couple of bubbles that have been inflated by central banks. But in the meantime, I'm enjoying the ride. I've been long the bond market in various ways. In my trading services and my investment services, and those trades are working out well. I think, again, ultimately, this is not going to be a good situation. But I think what's happening now, what sort of turbocharged this move, in addition to all the moronic QE, is that we have lousy U.S. economic data. I mean, let's be honest, that jobs report on Friday was terrible. It signifies that the U.S. economy, the economic cycle in the U.S. has turned for the worse. So not only are people buying bonds because central banks are buying bonds, now they're buying bonds because they think the economy stinks and is getting worse. So that's a whole new factor here. Now, I'd also point out that the dollar index is right on the cusp of a potentially huge breakdown. Huge, if you want to use the current political vernacular. You look at a weekly chart for the dollar index, and this sort of line in the sand or support zone around 92.5 to 94, kind of given that zone, is critical in my view. We've already seen the dollar break down against the yen. Now we're looking at, obviously, of the Brexit issue that's coming up, so that kind of muddies the waters for the dollar index a little bit, given the British pound's influence in the dollar index. But now you look at the Swiss franc, it's on the rise here. Gold is on the rise. And the dollar index, it bounced off of the 92 level a few weeks ago, but that bounce was crushed when the jobs number came out terrible. So now you're getting renewed downside. And I think that's driving a lot of markets. So if the dollar breaks down here, again, on a weekly basis, there's a lot of air under that chart. I think that you'd probably see the dollar break down, gold break out, bonds break out. And stocks, I guess it depends on what stock you're talking about. Some of the multinationals and mining type shares should do well, but those tethered to sort of U.S. domestic economic growth would probably do pretty poorly. So, and that would include banks, by the way. I think what would likely happen is the yield curve would get crushed as the U.S. economic outlook declines and people pile into the long bond. So, long story short, we're at some very critical levels in currencies and bonds. I would watch them very, very closely, because if we do break out here, I think that's going to be a significant market event, and it's going to drive some trading throughout the summer. So those are the levels I'm watching. Again, if you wanted to put some numbers on it, I'd call it about 93 on the dollar index. On the long bond futures, I'd call it about 167. If you're a yield person, you want to look at from the flip side, I would call it about 2.4% on the 30-year bond, and about let's call it 1.7, 1.65 on the 10s. That's all I got.
Okay, thanks, Mike. A lot of things to watch, including that relentless rise in bond prices to see if it continues. Mandeep Rai, are you seeing any relentless moves in your markets?
Hey, yeah, actually, good morning. That's a good question. And the relentless move we're seeing is the expansion in the multiple for the S&P 500 from a valuation perspective. We're trading at 19.5 times trailing 12 months, and that's the highest we've seen in multiple years. It's the highest we've seen since the Great Recession, and that's interesting because we're in the midst of a multi-quarter earnings recession. The earnings are actually going down, but equities are continuing to be being bid up, and if you see who the leaders are, and it's those high defensive, more mature companies that pay dividends and consecutive multi years of consecutive dividend paying strength. They have little to offer in terms of growth, but they do offer a shareholder payout. So we're talking about utilities, telecoms, other defensive sectors that are being replacing bonds in terms of yield. When you have almost 3/4 of the developed world in a negative interest rate environment, Japan and the European Union. Basically, that money is coming to the United States, and it's looking for yield. Where can they find yield? And that's where that money is hiding. Now, the market's had an unprecedented, very strong rally. We're talking to the tune of about 17%, and during a lot of that rally, we've had investors worried, skeptical, short, hedged, and so forth, because the economic outlook was not so great. And as that rally gained, a little bit more momentum on basically, short covering, you started to see sentiment turn a little bit. The AAII investor report, it's almost like a contrarian indicator. That's starting to turn a little bit more bullish. And you're seeing equities lift up because of that trade from, the covering, the capitulation, what if I miss this rally? And you're starting to see a bit of a correlation. Actually, not a bit. You have seen a strong correlation to what happens in oil. Oil has been rallying basically because of supply disruptions for short-term things. What could be short-term? We're talking about Libya, political unrest. We're talking about what's going on in Nigeria, the Canadian wildfires. These sorts of supply disruptions are making oil catch a bid. And oil's pricing in has a little bit of a risk premium in there, meaning that some of that could abate if any of these disruptions come back online. And watch what the market reaction is going to be to oil prices. And as Mike mentioned earlier, it's all following the dollar. Dollar weakness, lifting commodities, lifting energy-related stocks, and it's kind of a rotation within sectors as well. Because we already mentioned that the defensives have been performing very well, but within the other sectors, you're starting to see energy leading, while information technology and some of the other financials as well, because of the yield curve, have been rotated out of. In place of that, you're starting to see rotation towards energy materials names. So that's an interesting dynamic that's happening as well. So in terms of the S&P 500 at a heightened valuation and very, very close to a significant level of resistance, it's going to be interesting to watch to see what will ultimately cause these stocks to break out, because you have defensive leading and you have a rotation within sectors underneath those. So I think that we could potentially break out because of bullish sentiment and capitulation. When and if we do, you'll probably see the program traders, the algorithms the program trading and the algorithms lead this market higher, but potentially only to face the day of reckoning where all of a sudden we go back to retest those that breakout point and potentially even break down unless we get consistent outlook for earnings that we have troughed in terms of the stock market, so that valuation gets back into check. But that's something that needs to be watched. The other thing is, Mike already mentioned as well, was the jobs report. Are we ever going to get off of watching what the Fed does? This market continues to go up, whether or not the Fed wants to raise rates. If the economic report came out really well, very strong, then we ride on the possibility that the economy can hold its own. But with Friday's jobs report, that and the revisions previously were also lower. That leaves me wondering if we're actually okay. In a mature economy, in a mature bull market, one of the signs that you want to look for is an uptick in the unemployment rate. And even though we got a downtick, it was because of labor force participation just falling down and like breaking down completely. So, but the job creation is something that leaves me very worried. We went from 200,000 average for the last few quarters down to 38,000 in the last report. So that's something you want to watch very carefully. There are signs that we are maturing as an economy here as well, but I think that is a little bit dislocated because of our belief that the Fed is going to be the last backstop and hold us up and have throw more bullets at fire more bullets away at this the slow growth and deflationary type of environment that we're seeing across the world and affecting ours as well. So in terms of a portfolio, I'm staying cautious. I'm watching what's happening in terms of the resistance levels and potentially looking to add more defensive positions if we break out, and which I think will be suspect.
Okay, thanks, Mandeep. I guess that means the next few jobs reports will be more important than ever. David, you follow commodities. What are you seeing in your markets?
Hey, Mark. Thanks, everyone. It's interesting. Mike was talking about gold earlier. Gold looked like it, broke out in May, went up and got above that 1287 level, broke at the 1300 mark, but then came back into that range. It came all the way back down and actually broke the support at about 1207, but again, that was just a day or two break. And now we're back up into that range. So we're pretty much sitting in no man's land right now with that trading range between 1287 and 1207 on the downside. So right now it's a tough market to play. We did get a significant bounce after that jobs report last week. We're getting another pretty strong move today. But the real winners seem to be with this move in gold are the mining shares. They've really made pretty strong moves here. And right now, the way gold's trading, it's a tough market. I don't know if I'd want to be necessarily going long gold at this point. We're trading right around that 1255 range up to 1260. If we get through there, we can get up to that 1287 range. But to really get bullish again, you need to see us break that 1287 range and then potentially break that 1306 level on the upside. Then we really could get a breakout moving higher here again for the longer term. On the downside, that 1207 level is the key level to watch. Like I said, we briefly broke down from there. If we do that again, maybe we'll see a little bit bigger move to the downside where we get into that 1188, maybe to 1160 range. But for right now, it really is just that looks to be range bound until we get a more significant move outside of that range. With some of the other commodities, natural gas has had a pretty strong move. It actually moved right up into my target range, close to that 250 level where it actually hit this morning a bit. Right now, we're sitting there. If we can break above this, we might be able to move a little bit higher here. But I suspect right now there's quite a bit of resistance at this level that will either trade sideways for a bit or potentially pull back temporarily here before we make another move to really break through that level. Oil as well has made a pretty nice move. There's a good amount of resistance here between the $50, $52 level right where we're sitting right now. But there's also a lot of support on the downside around that $48 to $46 level. So I would expect to see us be a little bit range bound here for the next couple weeks. Probably bouncing between, I would guess, between 48 and the $52 level. The grain markets have also made another strong move, and actually they have started to break out again. Corn pulled back to about the 400 level. Now it's moving higher again. Soybeans didn't pull back quite as much, but that keeps moving higher. And one of the markets that was lagging a little bit in the grain markets was the wheat market, and now that's starting to look like that's on the cusp of breaking out here. So the grains themselves look like they could have a pretty strong move here coming up over the next several weeks to a month. When it comes to the equity markets, again, we're sitting right near those highs Mandeep mentioned. To get very bullish on this market, we would need to get a break to new highs, but not just a small break. We would really need to push and hold that level of that 2135 level on the S&P. And then you'll start to see more people get put money back into the markets here. We could get a bigger push higher. But until I see that, I would, again, trade cautiously at these levels. There's lots of support on the downside, so right now I do expect to see us be a little more range-bound here for at least a temporary time being.
Okay, thanks, David. Looks like some range-bound trading for gold and oil and even stocks. Kathy Lean, the dollar and currencies have been in the spotlight recently. What are you seeing in the currency markets?
Yeah, well, I think Mike did a pretty good job of touching on the outlook for the dollar. Last week, I brought up some figures talking about how June tends to be a pretty difficult month for the U.S. dollar as it gives up, what traditionally spectacular gains in the month of May. So we've seen that in progress already. The dollar index is down about 2% off of its highs, and it's down much more than that against many of the major currencies. It's down more than 3.5% against the yen, the Canadian dollar, the Australian dollar. And if you take a look at the individual currency charts, it certainly looks like we could see more momentum in many of the major currency pairs. But I think there's one very important thing to keep in mind, which is that, when you do have a weaker dollar, you do have a tendency of seeing, a lot of these currencies reached overstretched levels that make the central banks uncomfortable. We had a Reserve Bank of Australia meeting this week. They didn't emphasize the strength of the currency because Aussie has risen less than some of the other currencies, but the New Zealand dollar is currently hovering near a one-month high. The Reserve Bank of New Zealand meets tonight. They're not going to be happy with the consequences they're feeling, from the U.S. dollar weakness. The same is going to be true for the Japanese, where dollar-yen, the yen is at its strongest level in more than a year versus the dollar. So if the dollar continues to accelerate much more beyond current levels, and I think it could, simply because at this stage with the June FOMC meeting and with what Yellen basically her desire not to mention some sort of calendar guidance for a rate hike, suggests that the June FOMC statement is not going to be as hawkish as many investors anticipate. So that can actually lead to further weakness in the dollar. But the losses in the dollar will probably be limited by jawboning, in my opinion, from other central banks as we near extended levels in those currencies. But, it is having a factor, it's playing a very big role in the move that we're seeing in oil today and the move in commodities. So we are, like Mike started off, seeing a currency-driven environment. And, when you have such one-sidedness in currency movements, and you have the risk of, foreign central banks growing uncomfortable, sometimes the best opportunities are in the currency market and currency trades that we have been really, targeting are the ones that do not include the U.S. dollar. And so we've been taking the U.S. dollar out of some of our trades as the dollar gets more oversold in a sense, and some of the other currencies get more overbought. So that's why oftentimes we'll shift our focus away from the U.S. dollar as a result.
Okay, thanks, Kathy. Maybe some other currencies other than the dollar then taking the spotlight for a while. Well, that wraps things up for this week's Money and Market Squawk Call. Thanks to all our editors for their insights. Be sure to join us again next week for the Money and Markets Squawk Call. Thank you.